In this topic, we will cover some of the most important fundamental criteria that we look upon in a company. Fundamental analysis is needed to help investor choosing a good healthy company to invest in. It includes briefly description of income statement, revenue, earning per share, shareholder equity, and good cash assets. We look upon some important fundamental criteria that affect the fundamental performance of a company. Let me go to criteria number 1, which is the income statement. The income statement is one of the major financial statements used by accountants and business owners to see a company performance. The income statement is sometimes referred to as the profit and loss statement, statement of operations, or statement of income. We will use income statement throughout this explanation. The income statement is important because it shows the profitability of a company during the time interval specified in its heading. We will go through among the most important components of income statements, which are the revenue, earning per share, shareholder equity, and good cash in hand. The number 1 component included in the income statement is the revenue. Revenue is the amount of money that is brought into a company by its business activities. Revenue is known as the top line because it is displayed first on a company's income statement. Expenses are then deducted from revenue in order to obtain net income or profit. Investors will often consider a company revenue and net income separately to determine the health of a business. The one information that a great company possesses is its revenue and net income are hugely increasing from quarter to quarter. This resulted in the tremendously increased interest in the share price of a company in the near future. Trading and investing in a huge profitable company almost guaranteed a positive net flow in the long run. It also helps stabilize the emotion of the trader and investor by knowing that they are trading and investing in a growing company that will reflect their share price moving higher in the future. Earning per share, also called net income per share, is a company prospect ratio that measures the amount of net income earned per share of stock outstanding. In other words, this is the amount of money each share of stock would receive if all the profits were distributed to the outstanding shares at the end of the year. Earnings per share is also a calculation that shows how profitable a company is on a shareholder basis. So a larger company's profit per share can be compared to a small company's profit per share. Obviously, this calculation is heavily influenced on how many shares are outstanding. Thus, a larger company will have to split its earning amongst many more shares of stock compared to a smaller company. Earning per share is the same as any profitability or market prospect ratio. Higher earnings per share is always better than a lower ratio because this means that the company is more profitable and the company has more profits to distribute to its shareholder. Shareholders' equity is equal to a firm's total assets minus its total liabilities and is one of the most common financial metrics employed by analysts to determine the financial health of a company. Shareholders' equity represents the net value of a company, or the amount that would be returned to shareholders if all the company's assets were liquidated and all its debt repaid. Shareholders' equity can be either negative or positive. If the figure is positive, it means the company has more than enough asset value to cover its liabilities. If the figure is negative, the company has debts that outweigh its assets. In general, a company with negative shareholders' equity is not considered a safe investment choice because either its asset total is too low or its liability total is too high. good net cash per share is a company's total cash divided by its shares outstanding. Cash per share is the percentage of a firm's share price that is immediately accessible for spending. When a firm has high levels of cash per share, it is holding a significant percentage of its asset in a very liquid form. This decision can indicate economic uncertainty and an unwillingness by firms to invest given the current economic climate. High levels of cash per share can indicate that a firm is performing well with positive earnings and cash flow. These are the most important fundamental criteria when you look over a company financial income statement. The increased among all of these criteria indicate that the stock of the company is reliable and indicate the company is doing very well in terms of its financial current standing and have a very big potential to grow faster in the future.